Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Barnaby Wiener. He is a portfolio manager at MFS. In this wide-ranging conversation, we discuss the role of central banks in fostering irrational exuberance in the equity market and the challenge of truly investing for the long term, where management and asset owners are often too focused on benchmarks and quarterly performance. We cover how to be defensive in a market that's dominated by passive investments and growth at any cost. We explore how sustainability and stewardship is not really different from the historical teachings of fundamental analysis and good capital management. Finally, we conclude the conversation by discussing the misalignment of management incentives that have been exacerbated by central banks. I hope you enjoy the conversation. So I think that where the place to start this conversation today is the backdrop that we've created in markets, which is the increasing influence of central banks in supporting markets, and the potential risk that comes alongside that, which is the fragility that comes where markets always expect more and more stimulus, more and more liquidity to keep them alive. How do you think about that backdrop when you start to build a portfolio?
Well, I'd agree with you that is, in some ways, the overarching has been the overarching driver of markets for many years, certainly the last 10 years, possibly even longer than that. I guess my perspective has always been, to some extent, to ignore it, and in many respects, I mean, clearly that's been the wrong perspective in recent history. But I guess, I think it's important to emphasize, our approach is very much about taking a longer term view and trying to ignore the noise. I mean, I think one of the sort of the characteristics of markets today and life generally is we're sort of overwhelmed by sound bites and information and sort of what's happening today, tomorrow, over the next week or so, and it becomes harder and harder just to take a long-term view. And in the long run, I don't think central bank policy really has a profound influence on the value of businesses. It doesn't determine long-run economic growth, and it doesn't determine which companies are successful. So if you're building a portfolio for the long term, I think really you just have to focus on that, looking for good companies that you think have truly enduring economic characteristics and that are at a valued at a reasonable level. And if you can't find those, or you can't find them in sufficient quantity, then you have to sort of think about having a pretty defensive macro positioning in terms of, in our case, holding cash and using other tools to protect the portfolio, in the hope that one day you'll get an opportunity to exploit bargains and buy those good companies at a decent valuation. So the short answer to your question is, frankly, I'm inclined to ignore it because I don't think in the long run it will be the ultimate driver of corporate value.
Well, there's plenty of research, obviously, to substantiate your points there. I guess the challenge then for you as a portfolio manager is how to operate in an environment where many of the investors and the institutional investors are constantly trying to benchmark themselves against an index or their peers and so forth. And so how do you actually keep a long-term objective front of mind, and at the same time explain to investors that you need to be long-term to ensure that you actually get the outcomes that you want and you need for your members?
Well, I guess that the first thing is to be really clear with your investors what it is you're trying to do, and be really explicit about that. And so, in the case of the strategy that I'm involved in managing, we are pretty explicit that it's a long only sort of equity oriented strategy, but that our goal is to deliver absolute returns. It's not to be the benchmark year to year, and also articulate our broader concerns about excessive about that sort of irrational exuberance that you referred to at the beginning. And I think if you can get, if to some extent in the investing world, we're all intermediaries, and that creates a lot of agency risk. And the only way of surmounting that is by having a very sort of clear and open and trusting relationship with your clients. And I guess thus far, touch wood, we've been reasonably fortunate in that regard, and I think clients have understood what it is we're trying to do. But everyone has to buy into this that investing is a long-term game. That typically, if you think about the time horizon of the end investor, whether it's a you know a pension fund a holder or a private individual or a endowment or a foundation. I mean, typically these are individuals and organizations whose time frame should be measured in decades. So in that sense, it's illogical to be worrying about investment returns quarter to quarter or even year to year. Really, people should be thinking about where are we going on a 10 to 20 year time frame. And that's difficult, but I think that's the only way you can invest long term is if you have clients who are thinking long term.
So, how do you then think about the portfolio? You've obviously got a blank slate in terms of how you choose your companies and the types of businesses. Do you then think about what makes up a mixture of core value type companies for today with maybe some long shot style businesses as well that are more longer term growth, or how do you think about how to actually capture what's performing well today versus what may perform well in the next 10, 15 years?
Well, I mean, the first thing I'd say about portfolio construction is I think um, you have to be willing to cast the benchmark to one side and just say, you know, what the benchmark looks like is of no real interest um, to me in constructing a portfolio. And the fact that the benchmark may include a large number of banks or energy companies or whatever doesn't mean that I need to own those companies in my portfolio. In fact, the less my portfolio looks like the benchmark, the better. um, because as an active manager, that's what I should be doing is building a portfolio of companies that actually want to own rather than just companies that happen to be well represented in the benchmark. So that's the first important part of it. And then I think in terms of what kind of companies we want to own them, and it ultimately comes down to companies that can deliver our investment objectives. In other words, deliver a decent return over a long period of time. So I think the first question we always ask ourselves is this company going to be around in 10 or 20 years time? And when I say is it going to be around, is it going to be around and still profitable and not impaired in some shape or form? And frankly, that excludes quite a lot of the market because I mean, you look around at a number of industries and 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 conclude I have no idea whether this whole industry or certainly this company is going to be still prospering um, in 10 20 years time. And so it's about to me it's about focusing on durability first and foremost. It's more about durability than growth. um, I mean, in an ideal world, of course, one would love to own a company that can grow its revenues 20% a year indefinitely. But actually, in reality, that's very difficult um, because aside from the valuation conundrum, because of course, typically growth companies trade at much higher multiples. But even if you put that to one side, actually, high growth is very difficult to sustain, and it creates all sorts of risks. So, for example, managing a business that's growing at 20% a year presents huge challenges in terms of continually rebuilding up the organization, hiring more salespeople, hiring more engineers, creating the right infrastructure to cope with a much larger volume of activity without upsetting the culture, or you know undermining the sort of entrepreneurial spirit that got you there in the first place, without attracting more competition, without attracting more scrutiny from the regulator. So there are all these dynamics that make growth incredibly hard to sustain. And actually, there's been a lot of research done over this that basically shows how hard it is to sustain high levels of growth over an extended period of time. So to say, for me, it's more about finding durable businesses where you can be very confident that they'll still be around and that the downside is limited. Hopefully, they grow maybe a little bit ahead of GDP, but ultimately, the first, most important part of all is that they're durable.
The ironic piece to the type of the type of market environment we have today is that we have a whole stream of growth companies in quotations that are effectively zombies and not actually making money. They're growing revenue. They're leading the stock, leading the stock market in terms of market capitalization. They're having a large impact on returns, and so people come to expect that this is what you should be investing in, given the size of the businesses, and there becomes now obviously an issue that it sucks people in, that they need to look towards these companies that are hitting revenue targets and growth numbers, but as you say, they're not having the underlying fundamentals of cash flow to actually drive them as long-term sustainable businesses. It's a really challenged environment, I guess, for investors, where they feel that they want to invest in these businesses because they have the idea and mentality that these companies are the future and growth, but comes back to value, which you've discussed, they don't have the value that lines up with the growth that's there. How do you then have that conversation around the types of businesses that you want to own, with investors?
Again, I think you just have to be really disciplined and be willing to look different. I mean, I think in some respects, investing is all about being willing to look an idiot and be doing something that no one else is doing and be wrong. You know, you may be wrong for a long time before you're right. But ultimately, you know, if you if you can't resist the 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 urge to own those big names that are significant constituents in any ETF and held in most portfolios, um, then it's going to be a struggle to create a portfolio that looks different, that's active. I mean, the point is, you don't need to buy Apple and Microsoft, and not necessarily that they're zo- zombie companies, those two, but the big Amazon or in an active, because they're sitting in every passive portfolio, so you're not really doing anything that distinctive. But it's not just the sort of the mega companies. I mean, it's really it's a challenge across the board in that there are many good, solid, durable businesses that do generate decent cash flows, decent returns, but are now valued at such extreme levels that really the odds are to some extent stacked against you investing in them. And I think that that creates a big challenge for investors, because it's a bit similar to what's happened in the fixed income market. We have when you have interest rates pretty bond yields pretty well across the whole curve, at close to zero. In some countries, you've had at various points, 30-year bonds yielding nothing. Inevitably, it forces bond investors to take more and more risk, and you have, credits that are frankly junk, that, certainly close to junk, yielding almost offering no return. So, it's return-free risk. And I think to some extent the same is happening in the equity markets. It's you know the equivalent of the bond proxy in the equity market is now trading at such high valuations, offering such a low return, that then forces people to into sort of taking more risk. So it creates a very fragile situation.
So the margin of safety ultimately in these types of businesses is become almost nil. And so you've got nothing there, and the expectations of continual growth are so high that any misstep that these businesses have, there's quite a re-rating that comes next.
Absolutely, I think the point about margin of safety is so important. And there are two ways you can have a margin of safety. One is from valuation, and the other is from fundamental support. And the problem now is that most, pretty well every half decent company offers no margin of safety when it comes to valuation. So then you're digging around in the frankly digging around in the rubble of the rest of the market, looking for companies that may actually be not so bad as they appear. And there will always there will always be opportunities there, because markets always misprice at individual security level. But in general, it's an attritional activity, that because most cheap companies are cheap for a reason.
I wonder, how do you think about the amount of money that's been pouring into passive? Has that potentially reduced the inefficiencies in the market, or has made the market? How do you think about that's impact in terms of efficiency and the opportunity to find, mispriced securities?
It's an interesting question, and I don't really know the answer, because you would think eventually that if enough money flows into passives, that will create fantastic opportunities for active managers. Um, I'm not sure it has yet. I mean, arguably, it certainly has pushed up. I'm sure it's been a factor in driving markets higher, and particularly driving certain parts of the market higher. Um, but interestingly, I don't yet see real evidence that it's thrown up easy um, valuation opportunities in other parts of the market. And it's worth saying that it the growth in or the performance of some of those mega cap stocks may in part be explained by the strength of passive flows, but you can rationalize it in other ways too. You could say, well, look, um, what Amazon has done in, well, first obviously in e-commerce, but also in cloud, what Microsoft has done in terms of growing its cloud activity and its core business franchise, where Alphabet is in terms of its dominance of um, online advertising, etc. These companies are at the epicenter of a change in um, the whole dynamics of our economy, and you can justify their performance. I'm not saying I think that they're necessary in all cases good investments here, and there's plenty of reasons why on a longer term view I think one could be concerned, but you can certainly explain it that way. So I don't know. I mean, eventually I agree with you. Eventually, if there's enough money in passive, then that will throw out opportunities. I'm not sure that it has done so yet.
I'm curious to get your thoughts around the moves to shift away from shareholder primacy as the model, and how does that play into your thinking, as predominantly a long only equity holder?
I think it's a really positive move, um, and I think also, going back to the active versus passive distinction, I think ultimately um, it is why you know passive ownership of equities can never be a long-term solution. Because ultimately, um, to, a healthy system will involve not just um, people actively picking which securities they own, but also actively engaging with the companies that they own, which I think is a really important part of capitalism working properly. Um, but in terms of this, the the shareholder versus stakeholder primacy debate. I mean, this isn't new. The the purpose of companies, what a company exists for, has been debated and discussed for decades, if not longer. And I think there has always been this sort of natural tension between the different stakeholders of a company. Obviously, if you're um, you know if you're an owner of a business, ultimately you care about the value of the business and the income you can generate from the business. If you're an employee of the business, you care about your income from the business, and um, the environment that you work in. If you're a supplier to the business, you have a different interest. If you're the community in which the business operates, you have so every stakeholder has their own perspective. Um, but a good company, a durable company, needs to manage itself in the interests of all stakeholders. Because if it doesn't, you can't do without one of those stakeholders. You know, if you've got no customers, ultimately you've got no business. If you can't persuade anyone to come and work for you, you've got no business. If you, if you squeeze your suppliers to death, you got no business. And in any of those, and if you alienate the communities you operate in, you got no business. And ultimately, if you alienate the regulator, which is, essentially regulators and governments are just, the voice of that, they are to some extent the elected representatives of the communities in which companies operate. And if they say we don't like the way you're behaving, you got, that's ultimately going to jeopardize the future of the business. So as a shareholder, as a long-term shareholder, you're insane not to be worrying about the other stakeholders, regardless of your politics or ideals. It's in your interests as a long-term shareholder that the company is operating the right way. And I think that what's happened in the last 30 or 40 years is really as a reaction to the I think it's a reaction to the sort of ascendancy of left-wing politics in the 70s, both globally. At the time we were still worried that the Soviet Union was going to, march across the German plains and take over the world. But also within, many countries, you had very strong unions, very strong sort of left-wing politics in the ascendancy, high inflation, and it was, not a happy period. And so you had the sort of Thatcher-Reagan revolution on the back of the Chicago School of Economists all saying, markets, markets, markets. Milton Friedman saying the social responsibility of business is to increase its profit, etc. And that sort of unleashed this whole sort of wave of deregulation and shareholder value and all that stuff. And it just went way too far, and people have started to realize that. And obviously, I think the additional aspect of some pretty existential threats to society in the shape of climate change, obviously, but also I think sort of rising concerns about growing inequality, etc. It's just sort of turned the pendulum is now clearly swinging back in the other direction. But I think it should be seen as part of a very long term sort of a long term relationship between different stakeholders in society, rather than just some new um, new fad
Yeah.
that has just crept out from
Can
nowhere.
I put it to you that this stakeholder model is really what most of us were taught at university in terms of fundamental analysis as we looked at a company and we looked at the suppliers, the customers. There was the Porter's five forces. How does it differ from really what was done maybe 30 years ago?
I agree. I mean, I think it's really just going back to the basics of what a good company is, and I'd say it goes back. Some great examples in the 19th century. Um, in and I'm being a bit UK centric here. I'm sure it's not just in the UK, but there were these Quaker-run companies like Cadbury's and Rowntree's that were extraordinary visionary in many respects, in that they this is during the time of the Victorian era, where you had sort of workhouses and terrible social inequality and no safety net, and yet these companies were managed very much with a view to um, you know the social responsibility that the companies had to their employees and their communities. I mean, they built the first they built housing for their employees. They built schools. They built libraries. They provided healthcare. They built they started the first ever pension. There were sort of real visionaries, and they were wasn't driven by regulation or legislation. It was driven by company management that had a very clear purpose and a very clear ethos, and was determined to do things the right way. So I agree with you. This goes back centuries, not decades, and it's just the basics of running a good long-term business. And I think that's the key. It's the long-term. As soon as your focus drifts inwards to the sort of the next 3 to 5 years, then you're bound to look for shortcuts and forget about trying to create that balance and harmony. Um, and then that's a slippery slope.
I'm curious because recently you were appointed as the head of sustainability and stewardship. How has that changed your thinking, right? And that sort of feels like you're just giving more credence to your title. And so what changes as you think about yourself as a portfolio manager to now being in charge of sustainability and stewardship alongside your portfolio?
Well, I mean, it it hasn't changed my thinking. I think that my taking on this role reflects the thinking I already had, if that makes sense. In other words, I think I've always felt pretty strongly that um, that companies should operate in a certain way. That ultimately a good company, in terms of a company that creates value for its broader stakeholders, is ultimately going to be a good company for its shareholders. So that hasn't really changed. I think that what probably has changed in the last 5 years is I've become more preoccupied with um, some of the deficiencies in our system, where, for example, you know, we, the investment community, putting too much pressure on companies to deliver financial results, uh, often at the expense of our stakeholders, but also at the expense of our own long-term uh, security. I mean, they give you a classic example of this, and we talked about central bank policy at the beginning. I mean, one of the impacts of monetary policy has been to make the cost of money almost zero, and that's encouraged companies to take on a lot of debt and often use it to buy back shares. I mean, the whole notion of putting debt on your balance sheet to buy back equity, to me, is just utterly nonsensical. And if you were a family business, thinking, that where you're trying to build a durable company for the next generation, it would never cross your mind to do anything like that. But yet, public companies do it the whole time, and investment um, professional investors are guilty of encouraging it. In fact, ultimately, the blame lies fairly and squarely with the investment industry, not with the public corporation, um, or rather, not with the management. So I think that that has changed in terms of the intensity with which I feel, in some ways, our industry is being heading in the wrong direction. So I guess that motivated me to want to get more involved in playing a part and helping to rebalance. But ultimately, my core views about how companies should operate and how companies should be managed haven't really changed at all. And so my views about what sort of companies I want to own haven't changed at all.
Is there a problem with agency in the types of people that are running these businesses? If we went back 30, 40 years, a lot of the people that were CEOs of the companies that we saw were the owners, the founders of the business at the time. Now we're filled with management consultant style CEOs that run businesses optimized to the nth degree, which will potentially buy back shares because it makes sense to them and their incentives line up with that. Is that part of the problem, that we haven't got the right incentives for the types of managers that are leading these businesses today?
I think you hit the nail on the head. It's a huge problem. Um, and so the question is, how do we eliminate, or how do we sort of mitigate that agency risk? And part of it definitely does come down to incentives. So if you look, I mean, I'll give you an example. I mean, Japan is a country that um, is generally pilloried by the global investment industry for the quality of its corporate governance. And there's some justification. I think, I'm not saying Japanese companies are perfect. Japanese company boards tend to be founder dominated and tend to be, they don't score highly on diversity on the whole. But there is one thing about Japanese companies which I think is hugely admirable and should be should be replicated globally, which is that management are not juiced up to the eyeballs with stock incentives, and their primary incentive is actually as a sort of cultural one, which is as a Japanese company manager, your primary goal is to make sure you have a robust business to hand over to your successor. Not going bust is the sort of primary goal of most Japanese companies. Now you can compare it to the US, which is at the other extreme. You have these sometimes just frankly obscene incentive packages which are offered to managers, which give them the opportunity to become not millionaires, but in some cases billionaires over a period of a few years if they can achieve a certain outcome in terms of profitability and the share price. So it creates huge adverse incentives. Now, how do you correct for that? I mean, obviously, you could say, well, look, let's get rid of all this stock comp, or let's do it a different way. Let's say, we bring on this manager and we say, okay, we're going to give you this much equity in the business, but you have to match what we give you by putting in, your own personal money. So you've got real skin in the game. It's not just a free option, and you've got to keep it locked up for the next 20 years because the decisions you make for this company should be impacting its future in 20 years' time, not in 3 years' time. Now, the trouble is, you could try putting that incentive in place, but if that same potential CEO has got 3 other companies all saying, well, look, here, what we're going to offer you is this, which will probably make you very rich in 3 or 5 years' time, it's just very difficult. So I've struggled with this because I know the system has to change, but it's hard, and we have these conversations with companies a fair amount. It's quite hard for a company to deviate too far from market practice and not not suffer it. There are some that do. I mean, there are some great examples. I'll give you one just quickly. There's a Canadian company called Constellation Software, fantastic company in terms of the corporate governance and culture, and it's operating in the technology industry, which is probably the worst culprit when it comes to egregious stock-based comp. Constellation Software has never issued a share to its managers. Instead, every senior, and not just the executive managers, but the top 300, has to put 75% of their cash bonus back into company stock and keep it for up to 5 years, with vesting periods over 5 years. So really, they're forced to have true skin in the game. I don't know, it works there. They've got a very strong culture. I'd love to see that implemented more broadly, but it's a challenge.
But there needs to be a lot of pressure. We've seen a huge amount of pressure on diversity and green related initiatives and so forth. There's enough money in the asset owner community and the asset management community to push back. And I sort of wonder why. Is it just convenient to look the other way and allow for these very large option packages to be paid out because the stock and performance has been doing well? So it doesn't really matter. And like you say, there are a number of examples of CEOs walking away with billions in executive compensation, which in my own opinion doesn't seem to line up with the ESG qualifications and metrics that they seem to profess on a day-to-day level. I'm not sure how that lines up. So is the problem almost a failure of capitalism almost in trying to align the right incentives? How do you think about where did it go wrong?
It definitely is. I think you're right. There's a failure. I think that there are some failure of capitalism is quite a loaded term, and I don't want to use it just because ultimately, to me, capitalism is the only workable model, but it needs to be refined dramatically. So there's definitely there are many aspects of it that need amending, and one which you point to there is really goes back to the point about active ownership and invest in the investment community taking responsibility as owners of companies to play their part, because I think that it's not just when it comes to executive comp. It's across the board. By and large, the investment industry has been incredibly passive, regardless whether it's active or passive in the traditional sense. It's been passive in terms of its relationship with company managers. It's been far too cozy. There's a sort of we all prefer a sort of easy, cozy relationship than a confrontational relationship, and to some extent, investment firms feel the need to cultivate good relationships with company managers because they want access. They want to be able to discuss how the business is going, because that's sort of helpful in terms of forming their views. So there's a concern about alienating company management, but ultimately we as an industry have a responsibility. And so you're absolutely right. We need to be more disciplined when it comes to both obviously ultimately how we vote, but before that, actually how we engage with companies on these topics, engaging with the board and having these sometimes awkward conversations about what the company is doing in this way or that. So absolutely, it's true for executive comp, and it's true for many other aspects of the way the companies run.
I'll bring the conversation back to where we started, which was around the central bank and central bank policy. How much has the central bank, in lowering interest rates and providing a lot of liquidity to the markets, actually helped to sustain a lot of these potential problems that we've seen with inflated share prices, the misalignment of incentives, and so forth? Is that part of the problem?
Yeah, I think it's a huge part of the problem. I mean, I think in someone somewhere point in the future will write the history book about this, and that will be the sort of the central question, which is in this sort of age of supposedly unfettered capitalism, we actually had the opposite. We had highly a highly regulated model of capitalism. Only the regulation was working in the wrong direction, because in a sense that's what the central bank policy is, a form of regulation. It's a central authority coming in and regulating the temperature of the market. An unregulated market think what an unregulated market would have done in 2008 or 2009. And I'm not saying that would have been a good thing. I mean, we saw, in some ways, we know that, but Bernanke was a student of the 30s, and he'd seen what he was all too familiar with what happened when you have a market, a bubble burst and no sort of intervention. You have a depression, and that's what happened in the 1930s. So his whole mantra was must avoid a depression, so we have to shovel liquidity in until we stifle the problem. But it was somehow central bankers got addicted to their own medicine, and it's just, to me, incredible really that we've got to the point we're in, where every time there is just a whisper of agitation in the markets, policymakers are in there like a flash, shoveling money in, and their job is not to prop up the stock market, and propping up the stock market has helped people who work in the stock market. It's helped people who are wealthy enough to have significant exposure to the stock market, but it hasn't helped the broader economy or society as a whole. So it'll be one of those things that people write about in decades to come. How on earth this came about in a democratic era where everyone had a voice.
All right, I think that's been a fantastic conversation. Thank you very much for your time today, Barnaby.
My pleasure, Alex. Nice chatting.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.